You've seen the headlines when oil prices spike, right? Record profits, investor gusher. It seems like a sure bet. But what if I told you there are hidden traps in that price surge? Traps that can catch even the smartest investors off guard. In this explainer, we're going to pull back the curtain and look at the real mechanics of what happens when oil prices go absolutely wild.
To really get what's at stake here, we got to take a quick trip back in time. And look, this isn't just some dusty old history lesson. What happened back in 1973 is basically a blueprint for what can still happen today. An oil shock isn't some tiny ripple in the pond. It can literally quadruple prices and shake the entire global economy to its core. It's a pattern that repeats, and the lessons from way back then, well, they're absolutely crucial for understanding what's going on right now.
So, this leads us to the big question, right? When you see those prices just skyrocketing, what are you really looking at? Is it a golden opportunity to jump in, or is it a really dangerous trap? It's not a simple answer, and the first clue is in understanding the frenzy that kicks the whole thing off.
All right, let's break down phase one, the price spike. Something happens on the world stage, a conflict, a policy change, supply gets squeezed, and boom, suddenly oil prices are all anyone can talk about. It's exciting, it's dramatic, and it's exactly where the first big mistake usually happens.
You know, it all comes down to some pretty basic human psychology. You see that price chart going straight up, and that fear of missing out, FOMO, it kicks in hard. So everyone starts jumping on board, thinking it's an easy win. But here's the thing about commodities. What goes up often comes crashing down, and there's a very specific reason why. It's the classic late-to-the-party risk, and it's all driven by a powerful force called demand destruction.
This concept of demand destruction it's really fascinating. Think of it as the market's own self-defense system. When prices get too high for too long, the high prices themselves become the poison that slowly kills the rally. It's not some sudden collapse, it's more like a slow, painful grind. Let me show you exactly how it works.
This cycle right here is the key to everything. So it starts with a price spike. You feel it immediately at the gas station, right? But then, that extra cost starts seeping into everything. Shipping, manufacturing, the food on your table, you name it. That's when we all start cutting back. Maybe you cancel that road trip, or you just buy a little less at the store. Businesses see this, and with their own costs rising, they slow down too. And that's it. The very demand that was holding up that high price suddenly starts to evaporate, and the price comes crashing down, catching everyone who bought at the peak.
Now for trap number 2, and honestly, this one is a big one. You've probably heard the conventional wisdom. Oil prices are soaring, so just go buy energy stocks. Sounds simple enough, but the reality is way more complicated than that.
So let me ask you a question. If oil prices double, do oil companies just automatically double their profits? It seems obvious, right? Like a no-brainer? But for a whole lot of them, the answer is a surprising no. And it all has to do with how they manage risk.
There's this strategy called hedging, but you can just think of it like an insurance policy. See, oil companies have to plan these huge, expensive projects years in advance, so they absolutely need stable, predictable revenue. To get that stability, they sell a chunk of their future oil at a locked-in price, maybe $80 a barrel. If the market price crashes, they're protected. But if it skyrockets, well, they don't get the full benefit. This slide really shows the two completely different worlds these companies live in. On one side, you've got the unhedged producer. They're the gambler, the risk taker. When oil hits 140 a barrel, they are making an absolute killing. But if it crashes back to 50, they could be wiped out. Then on the other side, you've got the hedged producer. Yeah, they miss out on those huge windfall profits when prices spike because they're stuck selling at their lower, locked-in price. But they sleep well at night because they're safe if the market crashes. So when you look at an energy company, you have to ask yourself, is this company a gambler or is it an insurance policyholder? Okay, on to our third and final trap, the slow burn. And this one affects all of us, not just investors. That immediate pain you feel at the gas pump, that's just the opening act. This is what economists call cost-push inflation. And it happens because oil is, well, it's in everything. We're talking plastics, fertilizers, medicines, and of course, it's the fuel that powers every single truck, train, and ship that brings you pretty much everything you buy. So when the price of oil goes up, eventually the price of everything goes up. And here's the crucial part, the real kicker. This doesn't happen all at once. Take a look at this timeline. The shock hits, and yep, within about a month, you're seeing it at the gas pump. But it can take 3, even 6 months for those higher costs to ripple all the way through the system, to the price of everything else. That's why the real economic pain often shows up long after the initial media frenzy has already died down. And if you want a perfect, kind of scary, real-world example of this,
You just have to look at the 1970s. You had this massive oil shock hitting an economy that was already a bit weak. And the result was this absolute nightmare scenario called stagflation, where you get hit with high inflation and high unemployment at the exact same time. It's a powerful lesson in how an energy crisis can spiral into something much, much bigger.
But, and this is a really important but, it's not all doom and gloom. As scary as that 1970s comparison sounds, our economy today is a very different beast. We're just a lot more energy efficient. In fact, the global economy is 57% less oil-intensive than it was back then. That means we use way less oil to produce the same amount of stuff. So, while an oil shock definitely still hurts, we're in a much better position to handle it.
Okay, let's put it all together now. We've talked about the initial frenzy, the hedging myth, and that slow burn of inflation. So now it's time for the final act of our story, the inevitable crash. Because as we all know, what goes up?
There's an old saying in commodity trading, and it's one of my favorites. The cure for high prices is high prices. It sounds like a riddle, but it perfectly captures everything we've been talking about. The price spike itself creates the very conditions for its own downfall.
And here's how that full cycle plays out. The spike causes that delayed inflation we talked about, which forces everyone, regular people and big companies, to cut back. That is demand destruction in action. And as the overall demand for oil falls, well, that super high price just can't be sustained anymore. And then comes the crash, often just as fast and furious as the initial spike, catching all the latecomers completely off guard.
So let's just do a quick recap of the three big traps. First, you've got the late-to-the-party risk, jumping in right at the peak before demand destruction kicks in. Second, there's the hedging myth, remembering that not all oil companies win because some are locked into lower prices. And third, the inflation lag, where the real pain for the economy doesn't even show up for months.
And, that brings me to my final point, and I think this quote just says it perfectly. We can analyze the markets, we can look at the charts all day long, but at the end of the day, the biggest risk isn't in the investment itself, it's in the investor. It's about how we react to the hype and to the fear.
So I'll just leave you with this one question. What kind of investor will you be? The one who chases the headlines, or the one who actually understands the game being played? The traps are always going to be there, but if you understand the cycle, you can start to see what's really going on behind the scenes. And maybe, just maybe, you can get a glimpse of what's coming next.